Welcome back to Investing Talk Podcast.
Today we're looking at a key player in the energy storage space, EOS Energy Enterprises.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We are talking about a company that is really positioned right in the middle of one of the world's biggest energy problems.
Which is storage.
Exactly, storage. You have all this solar and wind, which is great, but it's intermittent. So without these, massive efficient batteries, modernizing the grid is basically impossible.
And that's where EOS comes in. They have a pretty unique solution, right? It's not the usual stuff.
Not at all. They specialize in proprietary zinc-based energy storage solutions.
Okay, so when we talk about batteries, everyone's mind just immediately goes to lithium-ion. That's the default.
It is, but EOS is tackling the big problems with lithium, especially for huge stationary grid use.
What kind of problem?
Well, two big ones. First, supply chain instability, relying on certain minerals from certain places. And second, and this is a big one, the safety concerns. These large-scale lithium setups can be risky.
Right, you hear about the fire risk.
Precisely. So the whole investment case here is built on a chemistry that's just inherently safer, more stable.
And that's the zinc hybrid cathode.
That's the one. That's their intellectual property, their moat, really. And for anyone listening who isn't a material scientist, what that means is you get a battery that's non-flammable, it can last longer, and it doesn't need all those geopolitically sensitive materials. Zinc is everywhere.
And because of that, they're not trying to get into your phone or your EV.
No, this is heavy-duty stuff. It's built for the grid. We're talking megawatt to gigawatt capability.
Which is absolutely essential. I mean, you think about grid modernization, big renewable projects, and now the huge power demands from AI.
Oh, the AI revolution. Data centers need just enormous amounts of stable power. And our current grids, well, they really struggle to deliver that without storage.
So the market should be responding to this. Are we seeing that?
We are. The commercial momentum is, frankly, it's explosive. Just look at the recent results.
Okay, let's do that. Q3 2025 revenue.
Hit $30.5 million.
Yeah.
But here's the kicker. That number doubled from Q2.
Sequentially, it doubled in one quarter.
Yeah. That isn't just growth. That's serious acceleration.
And if you zoom out a bit, the whole year.
It's even clearer. The trailing 12 months revenue is now $63.5 million. That's year-over-year growth of over 300%.
300%. I mean, just think about what it takes for a manufacturing company to scale threefold in 1 year. The demand must be off the charts.
And it's not just hope. It's quantified in actual contracts. Their contracted backlog, these are signed deals, is at $644 million.
Whoa. $644 million. That's almost 10 times their current annual revenue.
Exactly. It's a huge indicator of what's coming.
But even that backlog, that's just a piece of the pie, right? What does the total pipeline look like?
That's where it gets even crazier. Their quoted commercial opportunity pipeline, so projects they're in active talks about, has ballooned to $22.6 billion.
$22.6 billion.
And maybe the most telling part is that the pipeline grew 21% just in the last quarter. It shows the demand for this kind of non-lithium solution is picking up speed, not slowing down.
Okay, but this is where it gets tricky. I mean, when a company is growing at 300%, the biggest risk is that costs just spiral out of control.
That's the execution challenge, 100%.
They're building factories, hiring people, buying materials.
Right. But here's the crucial operational win from Q3. They reported a gross margin improvement of 92 percentage points.
92. That's huge. So for our listeners, gross margin is basically what's left after you pay to make the product.
Exactly. And a jump like that, it strongly suggests their scaling efforts are working.
Yeah.
They're actually reducing their per unit costs. The cost curve is finally bending their way.
And that margin improvement, that's the bridge to the financial side of this, which is, well, it's tense.
It's very tense. The momentum is fantastic, but scaling this fast is incredibly expensive. They've made a strategic choice to go for market share over immediate profit.
A choice that comes with a pretty big price tag. If you look at their net income, it's a loss.
A big one. On a trailing 12-month basis, it's a negative almost $2 billion.
$2 billion, that's a scary number.
It is, but you have to frame it. That isn't just money disappearing. That's the capital cost of building the factories and the supply chains you need to service that $500 million backlog.
That's
The cost of growth in this space.
Okay, so what matters isn't the number today, but the direction it's heading, the trajectory.
The trajectory is key, and it's improving dramatically. We can see this in the analyst EPS forecasts. For 2025, the consensus is a loss of about 41 cents a share.
Which sounds bad until
Yeah.
you compare it to 2024.
Exactly. In 2024, it was negative $4.55. So that is a stunning improvement. And it's forecast to get even better to negative 34 cents in 2026.
So they're pushing hard towards that break-even point as that massive backlog starts to convert into recognized revenue.
That's the plan. But for anyone looking at this, you have to be obsessed with one word: liquidity.
Survival. In a cash-burning business, cash is everything.
Right. Management says they're focused on working capital and extending their cash runway.
Let's unpack working capital for a second. That's really important here.
It's vital. It's the gap between what you have to spend now on parts, on labor, and when you actually get paid by your customer. With a huge backlog, you can actually run out of cash while being incredibly successful on paper.
Did you have to build everything first?
You have to build it first. So that's the core operational risk.
Right.
While we don't have the latest granular details on their cash and debt, the risk is clear. Scaling this fast can lead to bottlenecks or quality issues. That backlog is only an asset if they execute perfectly.
So are they doing anything to address that financial tension?
They are. And it's a bit technical, but in November, they executed what's called the Fifth Amendment to their credit and guarantee agreement.
Sounds like boring legal paperwork.
It sounds like it, but it's a really strategic signal.
Yeah.
It means they're working with their lenders to get more operational flexibility, adjusting the rules to give them the financial headroom they need to keep growing.
Okay, so that brings us to the market. How is Wall Street digesting all of this? The tech, the backlog, the financial risk?
Well, if you just look at the stock chart, the technical setup is pretty telling.
It's bullish.
Distinctly bullish, yeah. The stock has been making a clear pattern of higher lows since August. That's not just random noise. That suggests investors are buying the dips. It's accumulation.
And it's staying above the key moving averages, the 50-day and 200-day?
Consistently since Q3. For traders, that reinforces the long-term uptrend. It suggests this isn't just retail hype. There's sustained institutional belief here.
You have to mention the volatility, though.
Oh, you absolutely do. The beta is high. It's 2.14.
So for anyone who doesn't know, a beta over 2 means if the whole market moves up 1%, this stock tends to move up over 2%. And the same on the way down.
It's a roller coaster. It reflects the huge potential upside, but also all the risks we just talked about.
But that risk isn't scaring everyone away.
Not at all. Analyst consensus is positive. 6 analysts rated a buy. And we're seeing institutions make moves. Copperleaf Capital, for instance, just reported a new stake in November.
And at the same time, the retail crowd is still on board.
Very much so. If you look in the big investor forums, sentiment is strongly bullish. Everyday investors see the need for grid storage. And this is a pure play bet on that trend.
So with the chart sort of validating the story, what's next? What are the near-term catalysts we should be watching over the next, say, 3 months?
The big one. The most important event is the Q4 earnings report. It's scheduled for January 25th, 2026.
And everyone will be watching to see if that revenue growth continued.
That, and if that 92-point gross margin improvement was a one-off, or if it's sustainable, if they show that cost efficiency is sticking, that would be huge.
But beyond that one day, there's the backlog.
That $644 million backlog. We should expect a steady stream of news in Q1. New customer announcements, project milestones, shipment updates, anything that proves they're executing.
And there are also some market mechanics, right? Things happening in December and January.
Yeah, the stuff people often forget. You have ETF rebalancing on December 15th, which can affect things. And then January 15th is the institutional ownership disclosure deadline.
So we'll find out who else besides Copperleaf has been buying in.
Exactly. A big name showing up on that list could really spark a lot of new interest.
Okay, so let's shift gears a bit. Let's get into the more speculative side of things, the rumors.
This unverified chatter, yeah. This is the stuff that can cause those really sharp, sudden moves.
What's out there?
There are persistent, unconfirmed reports about large-scale utility partnerships. A lot of the focus seems to be on projects in the European Union.
Which would be massive. A major international utility signing on would be a huge validation of the technology.
Global stamp of approval. And then, of course, whenever you see growth like this, the acquisition rumors start instantly.
A takeover.
Or even just a large energy company taking a strategic stake, 10 or 20%. A big established grid player might decide it's easier to buy this tech than to build it themselves.
And what about technology partnerships?
Also hearing some chatter there. A potential partnership with a major established battery tech firm. That could open up new manufacturing opportunities or new ways to integrate their system.
Now, we have to stress this.
Absolutely. We have to be crystal clear. These are unverified rumors, the kind of stuff you hear at industry conferences or read on forums.
You don't build your core investment thesis on this stuff.
Never. But you have to be aware of them. Because in a high volatility stock like this, if any one of those rumors gets confirmed, it could be instant fuel for a massive move.
So wrapping this all up, how should someone listening think about this? What are the investment horizons?
I think there are two very distinct ways to look at it. For short-term traders, it's attractive. You can try to capitalize on the volatility around earnings and these news announcements.
High risk, but potentially high reward in a short time frame.
Right. But the real exceptional upside, that's for the long-term investor. Someone looking for multi-year exposure to the massive structural growth in energy storage.
If you just believe that grid modernization and decarbonization have to happen.
Then this company, with its unique non-lithium tech and its enormous backlog, is sitting right in the center of that inevitable trend.
So at the end of the day, the core trade-off here for any investor is very clear. You are weighing significant operational execution risk and capital burn, that $2 billion loss, against a truly explosive market growth potential fueled by massive global policy tailwinds and the non-negotiable push towards secure, modern grid storage. That high-stakes tension is what defines this opportunity.